Hey, everybody, we're going to dive into Warren Buffett's latest letter to Berkshire Hathaway shareholders. Before we do, please take a minute to click subscribe to my channel and check out a message from my sponsor, The Motley Fool, where you can get the top 10 stocks to buy right now. All right, so as usual, Warren Buffett delivered his latest letter to shareholders along with the company's fourth quarter earnings report. And there, as usual, there were a lot of interesting little tidbits of Warren Buffett wisdom. It's amazing how at 92 years old and 58 years into running Berkshire Hathaway, he's still finding new things to talk about. So, in no particular order, here are my five favorite takeaways. Number one is, why has Berkshire Hathaway really shifted its focus over the past decade or so away from buying wholly owned businesses or acquiring full businesses into really more of a focus on the stock market. Now, Berkshire has made a few big purchases over the past couple of years. Precision Castparts was its biggest acquisition ever. It also acquired most of um, Allegheny Insurance. But for the most part, Berkshire's investment strategy is focused on stocks. And the real reason is that the stock market is inefficient. It is easy, in Buffett's words, if you're patient, it's relatively easy to find good deals on stocks. We saw how he put a ton of money to work during the latest market downturn. If you want to buy whole businesses, not only is it tougher to find a bargain, but if it's a publicly traded company, you generally have to pay a premium, a significant premium over the current share price. So the market for buying whole businesses can be very irrational, but the stock market isn't. Patient investors have an edge when it comes to the stock market, and that's especially true when you have as much money as Berkshire does, and your universe of potential acquisitions that could really be meaningful is relatively limited. So that was number one. Number two, Buffett talked about the so-called secret sauce of Berkshire's returns. Now, since Buffett took over in 1964, Berkshire Hathaway has delivered nearly 3.8 million% total returns. I didn't misspeak. 3.8 million%. So it hasn't been this successful because Buffett has gotten everything right. Quite the opposite, actually. Buffett calls his own investment performance, most of his decisions are so-so. And if you look at his stock portfolio and how things are doing since he bought them, I would agree with that. But he called out a few of his big successes, specifically Coca-Cola and American Express. He spent $1.3 billion apiece on acquiring those stakes. He acquired them in 1994 and 1995. And since then, it's been incredibly successful. The two companies, Berkshire's stake in both companies, are worth about $47 billion combined and pay Berkshire Hathaway more than $1 billion in annual dividends between the two that can then be reinvested in whatever he wants. That's a home run investment, both of those. More recently, I would call attention to the Apple investment, which has only been in Berkshire's portfolio for less than a decade now, and Berkshire's already sitting on over $100 billion in profit. Do you think Warren Buffett is losing any sleep over the fact that his investment in StoneCo, for example, is down by $200 million when Apple is up by $100 billion from where they bought it? And the point is that a few big winners are really what makes a great investing career. He also joked that it helps to live into your 90s, but a few big winners can really overshadow losers. A lot of investors are sitting on a few losers right now, especially after last year, and especially if you're like me and added a couple of companies to your portfolio that went public through SPAC and really didn't do what you thought they would. So don't get discouraged by your losers. It's a few big winners over time, especially over 20, 30 years, can really overshadow them. Number three, Buffett talked a lot about stock buybacks. Buffett, who himself is a lifelong Democrat, buybacks have really been kind of vilified by the political left recently. And the reasoning is that instead of spending billions of dollars of excess capital on buybacks, it would be more beneficial to the greater good to use those to, for example, raise employee salaries, to reinvest in the business and create more jobs, things like that. And I totally understand that point of view, and I'm sure so does Buffett. But His argument is that buybacks are not harmful when they're done for the right reason. In fact, they're very beneficial. Um, to invest, most people are investors in one, either directly or indirectly through their 401ks and things like that. And if buybacks are done because the stock is a good value, everybody wins. Think about it this way: if I were to offer you the ability to buy a $20 bill from my wallet for $19, wouldn't it be in your best interest to do that as often as you possibly could? And that's kind of Buffett's argument here. The selling stockholders get the price that they want. The remaining stockholders are owning more and more of the company over time as the share count declines, and they're getting good value. It's instantly creating value when buybacks are done for less than the intrinsic value of the stock. The quote you see on your screen right there about Buffett talking about anyone who says buybacks are always bad is an economic illiterate. He didn't directly attack some of the politicians on the left, but that seems to be who that's targeted to. And he makes a very good point that buybacks are not always bad. A lot of times they are the best use of a company's capital because at the end of the day, management teams and boards of directors have a fiduciary duty to their shareholders to act in their best interest with company money. And if that they determine that the best interest of company, best use of company money is to buy back stock at a big discount, then that's what Buffett makes the argument. That's what they should do. Number four, and this isn't the first time we've heard this from Berkshire's management, that earnings figures are very easy to manipulate. In the past few years, especially during the 2020, 2021, growth stock explosion, we've seen a lot of companies report metrics like adjusted earnings, adjusted EBITDA. And Buffett or Charlie Munger, Buffett's vice chairman, called those, BS earnings not that long ago. Um, and they're very easy to manipulate. Adjusted earnings are like saying, okay, we lost $100 million last quarter, but if we hadn't given $80 million in stock-based compensation, had another $50 million in one-time expenses, and et cetera, we would have made money. So yes, you would have, but you didn't. So it is kind of a deceptive way to report earnings. And Buffett even makes the argument in his letter that operating income, which is what Berkshire relies on to really convey how much money they're making, can be manipulated pretty easily if managers want to. So he calls this a very disgusting practice and thinks it's something that investors really need to be aware of. Um, I'm personally a fan of net income, unless there's a really like Berkshire's a special situation because of their stock portfolio. Unrealized gains and losses are reflected in net income. So unless there's a special situation like that, I'm all about net income. I don't put much stock in adjusted earnings or any of those kind of manipulated metrics that don't tell you how much a company's actually making. And last but certainly not least, we learned that Buffett or Berkshire Hathaway is now the largest shareholder for 8 S&P 500 companies: American Express, Bank of America, Chevron, Coca-Cola, HP, Moody's, Occidental Petroleum, and Paramount. Berkshire Hathaway is the largest shareholder for all 8 of those companies. Um, that's a pretty big deal. This kind of shows you just how big of a component of Berkshire's business their stock portfolio has become. Buffett only mentioned 2 of Berkshire's businesses that would be among the S&P 500 if they were independent businesses. So this is a pretty big deal. Buffett has really, as I mentioned in the first part, really kind of increased their stock purchases, and some of these have been long-term home runs, like American Express and Coca-Cola, and have really grown into big, big, big positions. And kind of circling back to the third thing, buybacks are a big reason that Berkshire's stake has gotten so large in some of these companies, particularly the financials there. So hopefully you enjoyed that video. I'd love to hear what you thought of Buffett's letter if you read it. It's on Berkshire Hathaway's website right now. Please leave me any comments, and I look forward to hearing from you. Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.